In the early hours of January 23, 2026, silver printed 133 an ounce, triple digits, a number people joked about for years, until the market walked through it like the door was never locked. So here's the question everyone is asking in the same breath. Is this the top, or is this the Launchpad? Because when a market crosses a psychological line like $100, two stories start fighting for control. Story one says, this is euphoria, this is the blow-off, take profits. Story two says, no, this is the repricing, this is the beginning of the physical era. Today we're going to settle this the only way you can in 2026. Not with opinions, not with vibes, only with the hard data. First, the snapshot, what just happened. Price milestone, $100.33 Oz on January 23rd, 2026. Velocity. Silver is up roughly 40% in the first 3 weeks of 2026 alone, after a massive 150% gain in 2025. That kind of acceleration doesn't happen in a vacuum. It happens when a market stops being a trade and becomes a necessity. And that's why the gold-silver ratio matters here. With gold near $5,000, the ratio has compressed significantly. That compression is the market saying, silver isn't just following gold anymore. Silver is outperforming because it's being valued as a strategic industrial asset. Now, the most important line in this entire video, we are entering the 6th consecutive year of a structural deficit. In 2025, demand was about 35,700 tons against supply near 32,100 tons. That's a gap of about 3,600 tons. Convert that and you're talking well over 100 million ounces of missing metal. And subtraction problems end the same way. Inventories disappear. What does deficit actually mean in the real world? It means you can only pretend the shelves are full for so long. At first, the shortage is invisible. It's covered by available stocks, by leasing, by recycling, by paper promises, by delayed delivery. Then, one day, the shortage becomes visible. Delivery lead times stretch, premiums quietly rise. The phrase immediate availability starts vanishing from the conversation, and that's why $100 matters. Not because $100 is magical, because $100 is the moment the whole world finally looks up from the spreadsheet and realizes this thing is not cheap anymore. Now let's hear the top argument, the bear case, because good decisions don't come from ignoring the other side, they come from understanding it. Bear case, part 1, the chart looks stretched. When silver goes parabolic, momentum indicators like RSI can go deeply overbought. That doesn't mean collapse, it means fragile. It means a single wave of profit-taking can slice 10-15% fast. So the bear target zones start showing up like magnets. $90, $85, even $75, levels where late buyers panic and early buyers reload. Bear case, part 2. Mean reversion is real. Markets don't move in straight lines forever. If price outruns moving averages, it often snaps back to retest them. That's how it breathes. So the bear thesis says, even if the long trend is up, the near term can still punish greed. Bear case, part 3. Industrial thrifting. At $100, silver manufacturers feel pain. Silver is a cost input in solar panels, electronics, medical devices, and EV systems. The bear claim is simple. High prices force innovation. Companies will use less silver per unit. And yes, thrifting is real. Over time, engineers redesign. They optimize coatings, reduce thickness, change connectors, and squeeze grams into milligrams. The bear case says the price itself will cure the shortage. Bear case, part 4, sentiment gets crowded. When everyone suddenly discovers silver at the same time, you can get leverage. You can get hot money. You can get chart chasers. And leverage creates air pockets. When liquidations hit, price can drop faster than it rose. So the bear conclusion is, the move was too far, too fast. This is the blow-off. That's the case for top. Now here's the counterpunch. Bull case, the Launchpad thesis. This isn't a bubble, it's a shortage. And shortages don't end because a chart looks tired. They end when supply meets demand, or when demand gets destroyed. The key question is, can demand actually get destroyed in 2026? Let's talk about what silver is now. Silver is no longer poor man's gold. Silver is the new iron, the metal you don't notice until the whole system depends on it. AI data centers need power distribution, cooling, high reliability electronics. Solar grids scale with metal intensity. EVs add silver to wiring, inverters, and control systems, often estimated around 25 to 50 grams per car depending on design. And once an economy starts building for electrification, the metal becomes a throughput problem, not a fashion choice. Here's the difference between a speculative bubble and an industrial squeeze. Speculation can walk away. Industry can't. If a factory line is scheduled, if a utility project is funded, if an AI build-out is contracted, nobody says, well, silver's expensive, so let's just cancel the future. They pay the price, they secure the metal, they keep the project alive. Okay, you might say, but if the price is high, won't demand drop anyway? Some demand can flex, some can delay. But the demand that matters most is the demand with deadlines. You can postpone buying a necklace. You can't postpone a transformer replacement when the grid needs it. You can't postpone a data center expansion when customers are waiting. You can't postpone production when your competitor will take your contracts. That's why calling this a bubble can be misleading. Bubbles are optional. This looks like compulsion. Now, layer in supply realities. Mine supply doesn't turn on like a faucet. Bringing new production online takes years, not months. Refining capacity has bottlenecks. Scrap recycling helps, but it has limits, especially when industrial demand is rising at the same time. So when a deficit repeats year after year, it doesn't reset. It accumulates. And in 2026, the global flow is even tighter because new export rules in major refining hubs require licensing for certain silver exports. That's not a debate point, it's a constraint point. When constraints rise, the premium for reliable delivery rises with it. This is where the paper story starts breaking, because paper promises work until too many people ask for the thing the paper represents. A run on physical metal changes everything. When institutional holders demand delivery through large exchanges, metal leaves vaults. When vault levels drop to historic lows, the market stops being a smooth river and becomes a series of gates. Availability becomes conditional, delivery takes priority, and price becomes less about charts and more about timing. Here's the part most people miss. When silver hits $100, it doesn't automatically become too expensive. It becomes too visible. Silver at $30 is ignored. Silver at $50 is debated. Silver at $100 becomes a boardroom topic. That visibility can increase demand because it forces institutions to treat silver as a strategic input they can't outsource to luck. The moment your CFO asks, "Do we have guaranteed supply?" you've crossed into a different market. It's not "should we buy" anymore. It's "can we secure?" So what does a Launchpad look like in real time? It looks like this. The market breaks upward, then refuses to give the discount everyone is waiting for. Dips get bought faster, support levels climb, and every correction becomes a test of whether physical demand is still present underneath the paper noise. Let's zoom in on the paper versus physical idea without turning it into conspiracy. A futures contract is a claim. It's a tool for hedging and price discovery. Most contracts never end in delivery because they're designed to be closed, rolled, or netted. That system works beautifully when only a small slice of participants want the metal itself. The stress shows up when the slice grows. Not everyone has to demand bars. Just enough people have to say, "I don't want the spreadsheet outcome. I want the asset." When that happens, the market starts pricing two things at once: the price of exposure and the price of certainty. Exposure is what you buy when you want to be in the trade. Certainty is what you buy when you need the metal by a date. And certainty gets expensive fast because certainty can't be printed. Here's a simple mental picture. Imagine two doors in the same building. Door 1 is labeled paper. It's wide, fast, and crowded. People run through it all day. The tickets are cheap, the lines are smooth, and everyone assumes the room behind it is infinite. Door 2 is labeled physical. It's smaller, it's guarded, it's slower. And the moment too many people walk away from door 1 and start lining up at door 2, you discover a fact that changes everything. The second room is not infinite. That's what a Launchpad really is. Not a promise that price will only go up. A recognition that the floor is moving higher because the real-world bottleneck is tightening. And about thrifting, yes, it happens. But it's not a magic eraser. Silver has unique properties: conductivity, reliability, corrosion resistance. You can reduce usage at the margins, but you can't redesign physics. Plus, redesign cycles take time. Factories don't pause for 12 months while engineers rewrite the blueprint. So high prices may slow some demand, but they can also pull future demand forward as companies secure inventory before it gets even harder to source. That's why in shortages the consumer doesn't boycott the price. They prepay the problem. One more driver that can't be ignored: uncertainty. When global trade feels unpredictable and the US dollar weakens, capital looks for assets you can't dilute. That doesn't guarantee a straight lineup, but it explains why hard assets get bid even when headlines feel chaotic. Silver becomes both a hedge and a raw input. Quick. Now let's address the 1980 comparison because it matters. In 1980, silver's famous spike was driven by concentrated buying and a very different market structure. In 2026, the demand base is broader and more structural. But here's the simple math that resets expectations. That 1980 high near $50, adjusted for inflation, points to something closer to $200 today, just to match the old peak in real terms. So at $100, we can say two things at the same time. Yes, it's a massive move. And no, it's not the inflation-adjusted all-time high. That's why you're hearing big targets again, $150, $200, names like Robert Kiyosaki and other bulls throwing out numbers that sound outrageous until you realize the outrageous part already happened. Silver already doubled from $50 to $100. The first disbelief barrier is gone. Now let's build the top versus Launchpad decision like a checklist. Because if you treat this like a religion, you'll get punished. Treat it like a process. If this is the top, you would expect a sharp rejection at $100 that doesn't recover quickly, a cascade of lower highs and broken supports, a rapid cooling and physical tightness, easier availability, shrinking premiums, smoother delivery. If this is the Launchpad, you would expect a messy dip, then a fast reclaim of $100, higher lows that form above old resistance levels, continued delivery stress, metal moving, lead time staying tight, the paper price struggling to pull physical down. 3 realistic paths from here, so you're not shocked by volatility. Path A, the clean retest. Silver dips under $100, shakes out weak hands, then reclaims it and starts building above it. This is the new support story, where $100 becomes a battlefield line and every bounce trains the market to buy higher. Path B, the ugly flush. Silver rips, then snaps down hard, $92, 88s, maybe a scary wick lower, because fast markets love to punish late leverage. If that flush is followed by strong buying and higher lows, it can still be Launchpad behavior. The violence doesn't disprove the thesis, it often confirms how tight positioning became. Path C, the runaway continuation. There's no deep dip. Price grinds, then sprints toward the next psychological band, 110, 120, because buyers refuse to wait and sellers refuse to step in front of the train. This is rare, but it happens when the need-it-now bid overwhelms the take-profit crowd. None of these paths require you to be a hero. They require you to have a plan before the candles start screaming. Practical framework. 3 signals to watch. Signal 1. How silver behaves on the first real dip. If $100 breaks and price snaps back to reclaim it quickly, that's strength. If dips to $95, $90 get instantly absorbed, that's Launchpad behavior. Signal 2. The gold-silver ratio. If gold stays strong near $5,000 and the ratio keeps compressing, it tells you silver is still outperforming, still being treated as a strategic industrial asset. Signal 3, availability and premiums. If in stock becomes call for quote, if delivery gets delayed, if buyers keep paying up, then the chart is not the whole market. Now, a quick risk note, because you can be bullish and still be smart. Triple digits creates emotion. Emotion makes people do one of 2 mistakes. They panic sell the first red candle. They chase the top with no plan. A disciplined approach is boring, and boring wins. You can scale out a little if you need to protect life-changing gains. You can keep a core position if your thesis is structural. You can define levels where you add, levels where you wait, and levels where you admit you were wrong. That's not fear, that's respect. So, top or Launchpad? Here's the balanced answer serious people live with. A pullback is always possible. A pullback is even healthy. But the bigger question is whether any pullback is a reversal or a reset. If the deficit continues, if industrial demand remains sticky, if physical delivery keeps tightening, then $100 is not the end of the story. It's chapter 1 of the new price regime. Let me close with this. Markets don't ring a bell at the top, but they do leave footprints. And the footprint of 2026 is not just price, it's velocity, deficit, and delivery stress. Silver at $100 is loud, but the reason it's loud is even louder. So I'll ask you directly, are you holding through triple digits, or are you taking profits here and waiting for a lower re-entry? Drop your plan in the comments. And if you want the deep dive on which silver miners may still be undervalued even at $100 silver, hit subscribe, because the next phase of this story isn't about whether silver can move. It's about who gets metal and who gets a promise.